Thursday. Let's talk to an old friend now, Hugh Hendry, Eclectic Asset Management, former CIO and founder. Hugh, nice to see you on a day like today. You've been through this before. You've seen what has happened when you get these kinds of disturbances in the force, which we're seeing in markets right now. What do you make of them? And is the market basically screaming at central banks, enough, you're breaking things?
It's beginning to. I mean, there is still a profound misunderstanding about inflation, and the inflation data is still going to remain uncomfortably, visibly kind of high. The economic data, the real-time economic data, you know, the employment figures from last week, they're urging the Fed to go higher. Now, the inversion in the Treasury bond curves, and indeed the curves in Europe and globally, have been pointing for the longest time with regard to a profound danger in the financial plumbing. And I've said to you, I believe I said to you that today's 5% Fed funds rate in a world where debt is 4 times GDP. We're at the 20% where the Fed was in 1982, and you break things. We're breaking things.
Hey, Hugh. Oh, it's Alex in New York. How you doing? What breaks next? I feel like we had the UK gilt market break. Now we have some regionals. We don't know how many, but let's call it 3 banks so far. How do you know what's going to break next? What do you look at?
Well, I don't want to say that's easy.
Okay.
But I do want to say you follow the order of conceit. And actually, Silicon Valley Bank, there's an old classic saying that a nomen is a nomen, that there's a message within the title, Silicon Valley. And really, for me, it is, I want to I call them the venturists, the conceit of not marking to market. Yeah, we have not properly marked to market the gigantic private equity portfolios. Their clients don't want it marked to market. They don't want it marked to market.
They're paying not to mark to market.
They are. But again, it's a bit like with Caesar and what, Brutus, you've just stabbed me. You know, Peter Thiel and the Founders Fund. And what do they turn on their own and they pull the deposits out of the epicenter of the venturous world. Remember, this bank keeps you afloat as you await your next not fund, but your next funding round, You get 3 to 6 months and your cash is disappearing and they step in, right? What if there's no funding round? What if these darling little angel businesses leave our world of the living? I kept telling you, conjecturally, I've been seeing dead bodies. And now we're beginning to find them. So to answer your question, Alex, the largest VC companies quoted in the stock market, the largest property companies. The conceit there is we're just not getting transactions. And so you don't really, and there's no incentive again to mark to market, but following on from pandemic and whatever, no one wants like so much of the commercial property that's out there. We've just been able to shuffle it and not think about it. What's happening now is the market's getting more curious and it's kind of getting more fearful.
Where do you hide?
Well, I can't remember. Hiding, just walk away from the damn thing. It's a casino. Walk away, but okay, to answer
you have to put your money somewhere.
No, you don't. Well, yeah, okay, right.
Is it under your bed in gold coins? Like what?
Yeah, is it banks? Is it the front end of the Treasury curve? Is it?
It's the front end of the Treasury curve. You know, why, given all of this, right, why would you not accept 5%? You know, you wouldn't accept 5%
Hugh, can we really call that safe at this point when you're seeing such huge whippy action in the front end? Like, is that safe?
Well, it would not be safe if you were telling me that the Fed this year was going to hike to 7.5%. I'm willing to bet that the Fed's not going to hike to 7.5%. Now, ECB, now, think of me as the market. Yeah, I am the rain. I'm full of disdain. And the Fed's notions and their portions, they're only going to add to my pain. You know, this ensuring the deposit base, right? Right. So again, let's go back to the silly bank, okay? So, okay, deposits, not a problem. But what about the $75 billion of loans, again, that they have to these little angel companies? They're never going to raise more money. And the credit risk is like 0.8% of the total outstanding. Problems just multiply upon themselves. But to your point, yes, take the risk in 2 years. I dare you, take it. Gold coins. Let's be contentious. I'm very smitten by the grayscale trust. I mean, you don't hear many people saying that today. Why? Because crypto's had a profound mean reversion, okay?
Yeah.
And the I can't think of the proper appropriate adjective to describe the promoters of the trust, but you know they're aggressive and they charge 2% on a passive fund. But the passive fund now trades at a 40% discount. Mean reversion is my friend, right?
Right.
Bitcoin fell 80%. I can buy this trust at a 40% discount. I kind of like that. But is it going to go down? Yeah, it's going to go down.
Maybe. We'll see.
Oh, for sure it's going down.
Okay. In all of this, what is kind of, how does the process unfold as we start to figure out mark to market, as we start to understand how that ripples through the system? What gets kind of hurt along the way that shouldn't? Is the real economy separate to all of this, or is the real economy going to get caught up in all of this? Because at the moment, the real economy feels like it's still strong. The financial system feels like it's starting to mean revert, to your point, and we're starting to see the impact of a period of very low rates go to a period of very high rates very quickly. When does that start to come back into the real economy? Maybe you're starting to see it in Silicon Valley, but when does it start to have a meaningful impact in terms of tighter financial conditions and has a meaningful impact in slowing the economy down?
I mean, we don't see it in these financial hubs, but you know, you go and walk amongst the real people, the people who work in, you know, Amazon sorting centers and stuff, and say, hey, like, it's really good, and like you're not discussing my life. Professor Michael Pettis out in China and his collaborator, Michael Klein, Michael put out a chart and he showed real per capita US GDP, basing it 100 with the start of the Great Depression, okay? And he did the same for the US economy, third quarter 2007, you know, the beginning of the great financial crisis. Now, the real per capita GDP on the Great Depression, today, 190. Where are we? Where is today's economy? Do you care to guess? And let me tell you, it's 115. And we called that a depression. This was my point to you. We've been in this silent depression, and we've had a Federal Reserve raising interest rates. Now we see money supply actually going negative, but for me, I don't like commenting on money supply, because for me, I don't know if it's 20 or 40% of the overall, because we have to then think about the euro dollar, the creation of dollars outside the sovereign state of the United States, and I think that's dominant, and there is an outright deflation. So again, asset prices, even the best businesses, are going to be sold to meet margin calls, because we live in a very leveraged world.
Okay, so you said you want to hide out in the 2 year, you're talking about grayscale trust. Are you doing gold right now? Like, that kind of scenario really sets me up for a gold bug situation.
Heavens, I was giggling. Forgive me. This is the 2007, 2008 playbook. Everything, the strongest. You need collateral. You need something that banks will accept. Yeah. I mean, you know, again, the silly little bank, thank God it had all those treasuries. They bought them at the wrong price, but it was a currency they could give to the feds, okay? So gold, to your point, would have that attraction. But gold tumbled from, I want to say 1,100, gold halved from like 1,100 from the third quarter 2007 to the depths of despair in 2008. So it doesn't spare, even the best assets, if gold is the best
because
asset.
It's easy to sell?
Exactly, because it's the only thing you can sell. So forget that and come back again. I want to say to you, mean reversion. So we said the 2 year Treasury. Problem is you can't, unless you're a fund, you can't get leverage in the 2 year Treasury. So you need to go into the ultra long, the tilts, the TLT, okay? And I say to you that we've wiped out 20 years of positive price performance. We've wiped it out in 18 months. That is mean reversion. We're trading on we're trading below the 20-year moving average. If we ignore the carry, you've lost money in tilts, in treasuries for the last 20 years. And I believe we live in a world dominated by the capital inflows into the US economy from mercantilism, from Europe and from China. And that mercantilism turns mean reversion into profound profit opportunities. For me, the treasuries today are akin to where the S&P was in March 2009. You don't want to own them, but you got to own them.
So we're not going, you talk about the playbook going back to 2008. The playbook after that was to reduce rates aggressively and throw money at the system via QE. We're not going back to that.
Oh, heavens, yeah, of course. The Fed is really coyote. I mean, it just goes over. It should have been cutting rates like 6 months ago. It goes over the edge.
Yep.
And then things start to fall apart. They'll be at zero again. That's why, the TLT fell from 180 to like 99. It's going to be at 180 again.
When do they get to zero? Where does it get so bad that they have to get that aggressive?
Yeah, well, that's when I come back to the impossible nature of making money, being bearish or bullish. It's impossible because what you're going to see is the gyrations, the profound nature of the declines and the rallies.
Yep.
Make it impossible. Back in 2007, the economy stayed robust. The oil price went to $150.
Yep.
There's only one certainty in this world. The ECB will raise interest rates, okay, at the wrong time, okay? That's, again, the summer 2008 handbook, okay? But ultimately, there will be enough financial distress where the Fed will have to be at zero.
On that note, Hugh, lovely to see you as ever. Thank you very much indeed. Hugh Hendry, Eclectic Asset Management, former CIO and founder.